What's going on, everybody? It's James Nash, the Official Trader. Got my Tony Stark glasses on again. Love these. These are the Blu-ray blockers. Check it out. So what we're going to talk about today, hopefully this video does not auto adjust every 5 seconds. Matter of fact, autofocus, hopefully that goes away. Anyway, bid-ask spread. So I see so many issues with this, right? So we're going to talk about the bid and the ask spread. So your bid is generally your buyer. The ask is usually the seller, all right? And this is general, like buying stocks, buying options, etc. So you got option stocks, and we'll talk about limit and market orders soon. So what I'm going to say basically is that what I see the most is people struggling with getting filled, or, you know, I set this order but it never went through. Well, let me just tell you this. If your stock or option, either one, is continually going up and you put your order in here, do you really think that you're going to get filled down here at $50 per se, and the stock's already at $60? Do you think you're going to get filled? Let me know, because chances are not, until the stock comes back down to get your order. All right. So if you trade mostly on Robinhood, this is what you're going to normally have on your options. Now, here's the issue. Let me get a mark. The problem is when people do this, you know, they think it's a limit order, but if they're looking at a spread like Tesla, Shopify, Amazon, something like that, dude, these spreads could be $50, $100, $150 wide, right? So you put your order at 9:50 or 9:30 a.m. East Coast time. Say, you know, you put it at 10:50, which is $1,050, but your spread is, you know, $1,200. Your order could pick up anywhere in between that gap. All right. And I just realized that it's kind of in a blurry spot off the top of that one. So basically, what you need to understand, that's terrible. What you need to understand is the very simplicity of the bid and the ask spread, right? So again, the bid is for the buyer, generally, the ask is the seller. So if I bought the stock, now I want to sell it, okay? I am asking, we'll use $50 again, I'm asking $50, okay? Well, Johnny wants to buy it for $45. I'm not going to sell it for $45. So what's going to happen is now you have a $5 spread. All right. So somewhere somebody has to give. He's going to give, or I'm going to give. Okay. And we'll have, you know, say I'm willing to take, you know, $47, and he ups 2, I down 3. All right, cool. You know what? I'll take it. I'll sell it for $47. So now he gets this at $47. I was willing to let it go at $47. No big deal, right? Cool. That's your bid-ask spread in general, okay? Now, the issue that I'm seeing the most, and what, you know, a lot of people need to understand when it comes to options, is just because a stock itself has just massive volume on options does not mean the stock itself has massive volume. That does not mean the option will have also massive volume, especially like Apple, Shopify. I see SPY every once in a while. Shorter expirations do this. So say it's like 250, 50, right? All right, so general psyche, people don't buy these options. They will not buy this strike. Most people will not. If you look at open interest on something like this versus something like this, 255, more people will have this 255 than they will 250-50. Even though this is a closer strike in the money per se if it's calls, they're going to go for 255. One, because it'll be a little cheaper. Two, because it's an evenly multiple number. It's a multiple of 5. It's common to them. This is not common to anybody. Nobody's going to buy an option for 50 cents above a whole dollar value. It's just weird, okay? And that happens a lot, right? So I first found this out when I traded little small stuff, you know, So the IV would jump around. IV is implied volatility. I'm really hoping this video is not fading in and out, like trying to focus the whole time. I'm really sorry if it is. It's going to be a huge waste of my time. Anyway, so I found out on those little stocks to where the bid would be, this, but the ask would be, 25, right? So well, I don't want to pay 25. So now your median is like 15. Okay. Well, I don't want to pay 15 either. I want to pay 10. Okay. So I'll put an order for 10, limit order. Okay. I'll put a limit order for 10, and I'll let that sucker sit there until it gets picked up. It may or may not get picked up. If it doesn't get picked up and I really want to be in the stock because I know a move is coming, man, I'm going to sucker in and either pay 15 or I'm going to step over that and pay 20. Maybe I get filled at 15 if it's still, at that ratio. But chances are it's going to take it at 20, right? Because this person was willing to let it go, or computer or algorithm, whatever, whoever's controlling it will be willing to let it go at set price, right? So you need to understand that the bid ask is extremely important when it comes to options. And I'm saying that because, again, just because a stock itself has massive volume does not mean the options on that stock will have massive volume. All right, so let's erase this. Now let's talk about the simple differences between market and limit orders, okay? Now, I don't care what brokerage you use. I don't care if it's Robinhood. I don't care if it's Fidelity, TD Ameritrade, Webull. I don't care who it is or what it is. This is the deciding factor of what you get filled at. People talk about faster fills and this and that. Okay, I get it. Robinhood's a little behind on their technology. Guys, step that up a little bit, please. You really need to work on your charting, Robinhood, because Webull is blowing you out of the water. User friendliness, Robinhood all day. Webull app charting, I use it more than I do Fidelity Active Trader Pro, which you see here on my TV. All right, so what we need to think about is, okay, if I know a stock is about to do this number, right? Say Shopify, okay? One of those SEC deals, $5 increments, 5 cents times 100, $5, right? So $5 increment, all right? SEC rule. That is not generic. That is not something that only Robinhood does. For some reason, people think that Robinhood is like the bottom feeder of trading over here, right? Well, I've had all the brokerages pretty much, besides some of the newer ones that have just came out offering free stocks like Robinhood and Webull. And between Robinhood, Webull, Fidelity, I have TD Ameritrade. I don't use it because I don't like them. They margin called me one time for $15. I'll never trade with them again. For that reason, I've never been margin called with Fidelity, and I've had them since 2016. I'm sorry, actually 2013, but actively trading myself around 2016, 2014, 2016, somewhere in there. Anyway, but that is why, if you ask me why don't I use TOS, Thinkorswim, or TD Ameritrade, that is why. They exercise me, they hit me one time on a margin call. That's all it took. I'm done. I don't want to deal with you no more. You hit me for $15, dude. Chill. So that's why I don't use TD Ameritrade. I'm holding the grudge. Deal with it. All right. All the options: Fidelity, Chase, TD Ameritrade, Schwab, 65 cents on all your option contracts. Period. Right. Webull and Robinhood, the only ones I use that are actually free. I did get assigned purposely. I wanted to be assigned on OPK the other day. I got assigned back. I bought the shares. I turned around and sold calls against those shares. Finally, the expiration rolled up June 19th. Got exercised, $2,400. My payout was $23.99.80. They took 20 cents. Robinhood did. So there was a fee. Cool. You know what? I really don't even care about 20 cents. I made $1,000 profit on the trade. It's all good. I don't care. Okay? And that's something that a lot of you new traders need to understand. I don't care, right? You don't care. You don't care that you pay another $5. I mean, maybe you do, maybe you don't. Whatever, right? So we're going to be penny pinching here. Maybe you should just learn how to trade and read more about trading, maybe investopedia.com. Maybe you need to kind of learn what you're doing before you do it if you're going to be penny pinching $5, okay? Because say you make $500 on this trade, or you would have made $500 on a trade, but you decided to do this on a limit order because you didn't want to pay, say $75 for the option. All right, you wanted to pay $70 for the option. Okay, but that $5 has you over here, ball grabbing or whatever, and you don't get in the trade. Well, you look back at it and you're like, oh man, I didn't get fuel to Robinhood, man. That broker sucks, man. I don't like that, man. I couldn't get filled, man. I need to go to TD Ameritrade so I can get filled better, man, because I pay 65 cents for my trade, man. Man, shut up. Anyway, so the point being, it doesn't matter, all right? If you're not willing to lose $5 to make 500, just stop trading, okay? So the issue is, sorry if I offended anybody. Again, none of this is trading advice. This is all educational purposes. Please don't take anything I say as an act to trade, because that's just not what it is, okay? So, back to the point. Market order versus limit orders. It kind of coincides with bid and ask, right? So again, say I'm looking at a trade, right? So say Apple. We'll look at Apple right now, today. Perfect example. Apple is, matter of fact, I'll put it on the chart here. We're looking at SPY. Just in case you didn't know, 312 was the close. Beautiful, beautiful V recovery over here. This was right before coronavirus. This is tip top on coronavirus, March 13th, I believe it is. And now we're back way over here. This is coming across as a bullish pattern. Got some consolidation here on the, I got the 30 simple moving average mixed with the exponential 13 moving average, and we're here. Your Bollinger Bands. And this is one of the ways that I'm able to pinpoint my price targets for these stocks, right? And we're talking about the Bollinger Bands, right? Which is these huge white gap lines you see here with the huge fog in the middle. Your upper band, your lower band. Now I like Webull a lot on the app because it has the third band included. I haven't been on Fidelity Active Trader Pro in quite some time. Honestly, it's been like since the last time I did a video with this. But I use the third deviation, okay? That is the third deviation. Stocks, just so you know, Bollinger Bands are set up on like a 20-day moving average and a second deviation. Most stocks do not go outside of the second deviation. When they push on that second deviation, that is when they retract. However, stocks are known to run more on the outside of that second. But when they get to the third, when they're pushing on the third, if they step out and come right back in, it's coming back to the middle, or it's going to ride the upper line a little bit. If it goes up and just blows through it, or it stops and kind of generally touches it, that means it's about to pump up. All right. One thing you need to learn about the Bollinger Bands, especially the third deviation, the way I use them, this is huge. I'm giving you guys free information. This is what I do students with and everything else. This is something you need to understand. If you set your Bollinger Bands up like this, now I'm not guaranteeing it's going to be correct because anything can happen, especially with Trump being president and news flopping all over the place. Nobody knows where anything's going. When this upper band, per se, SPY is pushing up, leaning on the third band up, right? This band starts to turn down. We will absolutely, almost guaranteed, have a bullish movement on that. Vice versa. Say SPY pulls down, all right, starting to push on the third band on the bottom, but the top one is continuing to turn up. When the bands separate, that means your big move is about to happen, right? So you need to understand that. So on the third deviation, I also use a 50-day moving average, right? So I have it set here, 50-day, I don't know if you can see this, 50 moving average, so 50 candles worth, and I'm on the daily chart on a 1 year third deviation. So SPY almost touched third deviation here, but that's when Corona hit and boom. I was fully expecting us to touch 350 to 355, hell, maybe even 365 before SPY fully corrected and did this number maybe at this point in time. But, powers that be, or coronavirus and all this nonsense, that's what happened, okay? It's a bad thing to happen. A lot of people got sick or whatever. Just trade-wise, stay on top of the news. I used to think you could trade without watching the news based on just charting and things like that, but ever since Trump became president, you got people throwing bogus news, just like yesterday. Futures dove hard, and then turned around and came right back up because Navarro or whatever his name is said that the China deal was over, and then he come out saying that it's not. So that's what happened. Literally, the market said doop doop at the same time within like an hour. But anyway, back to it. So limit order versus market order. What we need to understand, very simple stuff here, guys. Apple pumping up. We're gonna put Apple on, like I said. And once you start trading, a lot, you'll start to know the symbols, especially the ones that you'll start to trade. So over here we got Apple peaking up to 372.38 today as a high, and it opened at 364. So I personally, every time Apple runs like this, it always comes back. Okay. Now granted, this was the coronavirus deal right here. I'm not expecting nothing like this. This was all the way down. This is just a massive buying opportunity right here. You're talking 212. You literally have almost doubled your money per share on Apple right now at $212 per share if you would have bought it at the bottom. But every time it runs up here, gets on these super highs, it has a drop, right? So there's your high of 327, and then you had a sell-off here on February 18th down to 314, just for it to pop back up the next day to 324, and then that's when the coronavirus news really started taking a toll, and that's when it started pushing down the market hard. I honestly did not think that it would recover as fast as it did, but granted, it was not a complete, and you saw SPY chart a minute ago, it was not like this, like it was in 2018 to 19 and December, January. It kind of rolled out more. So at this point, who knows? We could see SPY at 400 by the end of the year. There's no telling. But what I want to say is that, say Apple, right? So I feel like Apple is going to retract based on my charting on Webull. I feel like it's going to retract to the 350s. It could be 355, 357, 359. I don't really care what it is. But regardless, say we'll just keep it simple. We'll do shares. Say I want to buy Apple at 355. I don't want to spend, whatever it's at. It closed at 366. I don't want to spend that. All right, so it needs to come down roughly $10. Okay, $10 drop. Now this is going to be a limit order. That means I have set the order in for what I am willing to pay for said stock, Apple in this case, and now I will buy one share of Apple at 355 in the event that it comes back down. Now, would I change this for any reason? Maybe I'll change it if I deem that Apple is about to explode, and I will certainly want to be in before something else goes down. But here's the issue: if I choose to go market order, right, and the bid ask, of course, we say 366 is closed. Say we're looking at 366. And that's the ask price, bid price. Let's say it's 364, right? So that's a $2 bid difference. Nowhere near what I want to pay. So I'm still down here at 355, right? Issue is, I feel like Apple's going to open up tomorrow and just explode, right? So it's going to go up. We're going to touch 375 again or 390. Who cares? Whatever. I'm not going to sit and wait on this 355 if I know and have huge intuition that a move is about to occur, right? I want to be on that move, right? Whether it's an option, whether it's a stock, it doesn't matter. I want to make the money, right? So I'm going to sacrifice this $10. I'm going to jump up here, 365. You know what? Let me throw an order at 365. Mark it down over here. All right, 365. Boom. Say that worked. Say it picked up. Terrible market. In order to be some of the big ones. So boom, right there. All right, I got into my play on a limit order. It didn't go through because the stock was still $10 higher, and I decided I wanted to go ahead and just get in the stock, and that's exactly what I did. So again, that goes hand in hand. Limit versus market order. I think Robinhood generally is generic on options as far as that goes on limit orders, because fidelity wise it's kind of set up as market. You can set it to limit. You can kind of adjust your home page or whatever you want, on really any brokerage for what you want it to be automatically, right? So say you want it to be on limit orders all the time, it'll be on limit. Say you want it to do 5 orders, at a time, then you'll be good to go there. But the biggest thing is, and I'm going to go back to it again because I don't think I finished what I was saying. When it comes to the bid-ask spread on small options or stocks like bank stocks or biotech stocks, dude, these bid-ask spreads are huge. They could be $50 or $100 or $300 spread. You could have something that's like a $20 versus a $190 bid-ask, and that's just crazy. So let's say you bought 10 contracts, right? 10 contracts at 5, right? There's your multiple. So you got your multiple in. All right. Now say your stock moves $5 north, okay? Now your calls are worth, say IB's crazy, you're the only one with open interest on the contracts. Now it's in the money. Say they're worth 95, okay? But you're the only one holding contracts here. And the open interest is what you have. Maybe somebody else is holding some, but they're at 95 now. And you only paid 5. That is a massive profit, right? You've literally made $90 per contract. That's $900. That's amazing, okay? Now what happens when you go to sell at 95? Chances are the bid ask is so huge that it's going to drop down to 50 or 55 maybe. Well, why did it do that? Well, nobody else has the contracts. Just because the stock moved $5, everybody's buying the stock. That doesn't mean the option is being bought. That just means that people are buying the stock. It's reflecting the move. Now, if it expires in the money, you'll be fine. But when is your expiration? Is your expiration tomorrow? And you'll be $5 in the money? Is your expiration 3 months from now? Well, we don't know what could happen in 3 months. I mean, the market's bouncing up and down. They call it the kangaroo market now, right? So what's going to happen is you're going to have to be willing. I mean, you already made a ton of money. You pay $5 for a contract, you pay $50. So say $50 all the way to 55, right? Couldn't get 95, you tried 55, right? Man, you know what? 55 didn't work either. Now you're down to 30. And the price just keeps moving. It's just going down and down and down, further and further. You can't get in at 30. But 25. 25 works. You made $250. Guess what? No, you did not make your $900 out here, right? You made $250. $200 profit. That's cool, man. What's wrong with that? That's not bad. But you're mad because you couldn't get filled at 95. Well, why does it go that high? How is the price saying that? Well, that's the bid-ask spread. That's just how it is on options, right? The bid-ask on the stock could be 50 cents, whereas the option could be 10, 20, 30, 40, $50, $100. You don't know. But what you need to do is trade options that have large volume. It's going to be SPY, SPY, Delta Airlines, DAL, American Airlines, AAL, Apple, AAPL. Tons of stocks that are hugely popular. Facebook, Amazon, Shopify, Tesla, all these things, mostly out of the money on Tesla, Shopify, and Amazon because it's so expensive, because people with big money are the only ones actually able to trade in the money options on those. Unless you're trading debit spreads. So you watch my other videos, you'll see all the debit spreads. So, large volume, and what's the other one? Anybody? Ding, 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 ding. OI, which means what? No, it does not mean off implied volatility. Open interest. This is how many contracts are open on said option, all right? Now, if the open interest, keep it simple here. If the open interest is over 3,000 and the volume is, who cares, a couple hundred, 200, this is fine. This is not bad, right? Chances are you'll get in and out of that option pretty easy. Not a big deal. But say the open interest was 30 and your volume was 2, is this something that you want to buy? There's nobody to buy it. Unless you know something that everybody else does not, and maybe this is a year from now, you're fine, you know, not a big deal. But the only time that I've seen these options here work in favor of you making money are when you are in the money. Stock's trading at $2, say a penny stock you're trading an option on, you know it's going to have this huge move, they got some news coming or whatever. All right, you buy, say it's at $2.50, all right, $2.50. Say right now it's at $2.50, you buy it in the money, you buy your strike at $1.50, all right? You're already $1 in the money. Now say this sucker shoots up to $10, all right, boom. Way in the money. There's going to be zero problem selling this option for some sort of pretty great profit, right? Now, what could happen if you bought, say the stock is at $2, and now you're buying at the money for $2.50 strike. Guess what? You're already 50 cents out of the money. That is not going to be in your best favor in order to get out of this option if it does not move in your favor, right? So we need to be, again, $5, $10 a share. All right, so now the option is actually valuable. Okay, so now you'll be able to sell this no problem because you're way in the money. All right. Now, this is where it gets interesting. Would you buy 100 contracts at $1? So your total risk is $100. You bought a $10 contract, 10 strike. All right. Terrible. You bought 100 of them for $100, $1 each, $10 strike. That's where you need it to go. Stock's trading at $150. You got 6 months. It's one heck of a gamble right there. You may or may not be right. If the stock goes to $8, this option is going to imply a lot of volatility and potentially from your dollar to $10, $20, $30, $40, $50 a share, per contract. You got 100, so just do the multiplication there. That's quite a return. Should you do that? Probably not. Because is it likely that it's going to jump up to $10 a share? Maybe, or maybe not. But I'll tell you this, that one in the money option, or one at the money option at least, would have netted you pretty much a guaranteed return had it jumped to $8, but not 10. So it still has to be 10 to get you any real profit on the in the money. But if you're not, chances are you're going to lose money. What you need to know, again, limit versus market orders. If I want to get in right now and the bid is lower, I am going to buy the ask price because I want to be in Shopify when it jumps $30, okay? I don't want to be sitting on my limit order at, $150 per the contract that's out of the money for, 3 weeks from now. And Shopify is going to move $30, on my intuition, okay, cool. My limit's at 150. Well, she ain't coming back down. It's sitting at 175. This is the low of the day, you just don't know it yet. You're $25 away from getting picked up. You will not get picked up because this option is going to just trigger as soon as shop starts to make a bullish move. As long as that expiration is like 2, 3, 4, 5 weeks out, you're not going to really have any IV going against you or theta just killing your contract. 3 weeks, you're really starting to push it. Theta's really going to start rolling in at that point. The 30 days is pretty much my theta rule. If you get a contract less than a month on something big like Amazon, Shopify, Tesla, you're really going to start pushing it with theta when that contract starts to run out of time. If you're selling options, which is my favorite thing to do now, IV is actually in your favor because the higher the option premium goes based on IV, that's tremendous because if I sell that option, say I bought 100 shares at $2, looks like looks like part 2 now. Sorry about that. I'm gonna try to blend these together so maybe it'll run. What was I saying? So, totally just blank. So say you got your, wow, I really totally just forgot what I was saying. Anyway, back to marketing limit orders. So, Shopify, here we go. Shopify's 175, about to run. Lowest of the day, I wanted 150, not gonna get it. Now that's gonna go, and it's just gonna keep tuning it up and get higher and higher and higher. Next thing you know, Shop jumped $20 already. The premiums are $300 higher. For some reason, you think it's gonna keep running, right? It's gonna keep going, but Shopify always does this. Every single time it runs really, really hard for a week or so, it always has that moment where it just, profit takers most certainly take their profit, right? So you're just gonna suck it up, man. You're gonna have to pay $10, $20, $30 more a contract if you really want to get in. Now, what is that called? There's actually a term for this. It's called slippage. All right. Now, the broker, if there's a person doing this and they have this huge bid-ask spread, the broker actually makes the money in between. Okay. Most of the time, it's a computer, but if it's not, it is the broker who is actually receiving what's in between said spread. I really don't care about that. I'm making my money for me. I like selling my options. That's what I was talking about, selling premium. I don't care about the broker or whatever he's doing, whatever the computer's doing. All I know is I want to be in this trade because it's going to make me money. I don't care if I lose $5 or $10 on them, because guess what? More people lose profit by holding too long than they would jumping in a trade, losing $5 or $10 extra to get in the trade to make $300 or $400. Okay, tomorrow I'm going to give you $500 to show up here at 8 o'clock in the morning. You're going to show up on time. Every 10 minutes you're late, you're going to lose $50. Okay? Couldn't help it. Car broke down. I'm still going to give you $450. You got here. I'm going to give you $450. But you lost the $50 because you were late. You couldn't really help it, but it's all good. So, what we're going to do, you're going to get the money. But the limit versus the market. This is the big thing, because when you put a market order in, and that ask and bid spread is, $50 or $100 on Amazon contracts or Shopify contracts, you're going to get loaded on that high side that you don't want to pay for. But if you set a limit, say it's $2,100 against $1,900, all right, so you got a $200 bid ask spread there. Say you put a market order on this, chances are you're going to get filled somewhere in that gap. It could be 1950, it could be 2000, it could be 2100, it could be really whatever it says. And there's nothing you can do about it because you picked market order. All right. Now, if you put a limit order for say 1990 or 1975, chances are you might get picked up on that because the implied movements are moving fast. It's just something that you don't have to really worry about. But if it's a move that you think is going to happen right away, maybe you should go ahead and get in on it. Again, it's not trading advice, it's just something I will do, and I have done and do constantly. IV, right? So again, IV, theta, these are all things that work against you when you're buying calls. When earnings is coming up, IV is getting big. Anything over, in my opinion, 80% IV or higher, all right, 80% IV, this is where you start to lose money. When this gets up really high, 95, 150, 300, 700, 1500%, I've seen some crazy numbers, believe it or not. When those numbers on IV start getting really, really high, that is when you will lose money. When earnings are rolling around, IV just starts to spike super hard. And you best believe if that stock doesn't make the move that the option is implying to occur, this is going to destroy your position, especially when you combine that. You buy your 0-day trade expiration, good luck. Chances are, your 0-day trade versus your 1-day, like you bought it Thursday, expires Friday, chances are you actually have a higher probability on the 0-day not losing money if you paid a really low cost for it that morning because you get on a spike. Maybe you buy at the money contract to get it rolling, but the day before, if you bought that at the money contract, chances are you're going to lose your money because overnight the move didn't occur. Now you have theta hitting you again on that Thursday night. Whereas Friday it expires and you bought it for Friday, So now you'll just have to find out and see. But selling options is great. Selling puts, cash cover puts. Basically, you can use a Fidelity scanner. I love it. I did it with Apron. We're going to see how it turns out for January 2021 expiration. I got $300 credit. It actually shows in the account already, but you don't actually get to use it. Well, you shouldn't use it until said contract expires. So I have $973 or something in my Chase account, and it was an $8 put. So come January, if for some reason Apron drops back under $8 a share, I will have to buy 100 shares at $8. If it's $5 or $6, I'm about to lose some money. At that point, at $500, $5 a share, if I paid $8, I just lost the entire $300 premium. But I broke even. Not a big deal. It could have worked out better, or maybe not. Maybe it'll continue to $15, $20, $30, $40 a share, and I won't lose anything. I'll keep the credit as a whole, and it'll release my $900 or $800 collateral. That's what you need to understand when it comes to selling options. So that'll be another video. We'll talk about that again. But this is huge. Like, I get so tired of seeing the whole thing with the bid ask and the limit versus the market orders, and people talking about the fills. It's just really redundant because it's a constantly repetitive thing. I don't understand why new traders think that going with TD Ameritrade is going to get you out of the pattern day trading. It's in every single brokerage. It's an SEC FINRA rule. It is built to keep poor people out of the stock market. That's just what it is. You got people over here complaining about Robinhood. Robinhood actually shows you. Check this. I've had Robinhood since 2017, mid 2017. I've never, not once in that whole almost 3.5 year period now, I have never once gotten hit with the pattern day trading rule, and I've traded all the time. Trade Fidelity, Robinhood, Chase, TD Ameritrade back then, Webull. Never, not once been hit with pattern day trading. When I switched to a cash account, guess what happened? I got hit with it. I got hit with a good faith violation like at least 4 times now. The pattern day trading thing is anyone with 25,000 or less in their account. The moment you go 24,999, boom, you're registered, you're marked. Now they need to know you're limited to 3-day trades per week, 5-day moving window. Every 5 days it restarts. Whichever one you made on that 5th day drops off. If you made all 3 of them on the same day, they all drop off at the same time. You cannot avoid the pattern day trading and or good faith violations. It just does not happen. I made a video about it specifically. All right, I don't understand why it's such a big deal. All right, if you're getting hit with the pattern day trading rule that fast, like right when you started trading, you either A, you didn't know, it happens a lot, or B, you don't care. Sometimes not a big deal because you're still going to be able to trade, but now you have to sell it the next day. You cannot buy and sell anything in the same day at this point. So you would buy it today, you can sell it tomorrow. So what you need to understand, pattern day trading. All right, limit versus market order. Say, I don't know, man. It's like, don't trade crappy options. That's all I can say to this. Don't trade options that are crap. Don't trade options that nobody even cares about the stock. Nobody watches that stock besides funds and banks and places like that. Somebody, if it pays a good dividend, chances are maybe some old-term investors, long-term investors have it. But chances are nobody's flipping options on stuff like that unless you sell a premium. Because guess what? When you sell premium, you're guaranteed the contract. This is how it is. I'm selling puts on Delta. All right, AL. I'm selling premium for $27 or $28 a share. So that's locking up $2,800 or $2,700, or once Delta stock goes up, maybe $3,500, right? This is cash collateral, okay? So what you need to understand. I got in a credit for $142 today, all right? The one I had expiring this Friday was $117. I went ahead and bought it back for $19. I took the $98 as profit, okay? That is called accepting, right? I could have waited, maybe Delta stock dropped next week, and then I got a sign, or maybe it dropped Friday, and I got a sign on Friday. Well, I just prevented that by closing the contract because I bought it back to close for $19. Well, they gave me $117 to open the position. So I made $98 profit. Do you understand what happened there? Guess what? My $2,700 immediately was released cash. Now, guess what I did? I opened up another one for July 10th. All right, and I'm going to keep these rolling, and I'm going to keep them flipping. It's a new plan I got going on. 10 years from now, it should be really nice. I've done the math on it. Depending on what Delta stock price goes to, in the next year or so, that'll make all the difference. I don't think Delta is going to flunk out. I think they're going to be really strong once all this is passing and over. The other airlines, I thought they were in a much worse financial situation, but apparently not. They did pretty well. They're surviving. So what we need to understand is limit order, market order on stocks and options. These two, they go together. Limit, market, options, and stocks. Now, the bid ask really is geared towards stocks, okay? Not so much options. This is not going to be in your favor pretty much almost never on little baby options. Nobody trades biotech options and stuff like that on a small scale. Nobody, you're almost better off buying the shares because of the lack of risk. Because at least with the shares, you know a defined amount of what you may or may not lose. With the option, you have no idea what you can sell it for because maybe it doesn't have any liquidity, which is your open interest in your volume. If nobody's interested in buying it, guess what? You're not going to be able to sell it. Very, very simple concept. All right? Say I buy 10,000 shares of ABC, not a real stock, I just made that up. All right, 10,000 shares. And now I'm going to sell 10,000 shares of ABC. So buy and sell. All right, say I want to sell them. I bought them at, keep it simple, penny stocks, 50 cents. Say I want to sell them for $2. All right, 10,000 shares. Right, price comes up to 175. I'm making tons of money right now. Huge money. All right, nobody's gonna buy for this because it's currently this. Am I willing to lose 25 cents per share here? Even if, that's a lot of money. Don't get me wrong, it's a lot of money. But am I willing to lose 25 cents a share if I bought at 50 cents and I'm selling it at 175? 100% yes. Give me my profit. Give me a stake. I'm done. I don't need to sit in there and wait out to find out if I'm going to get filled on this 25-cent difference. Maybe it goes up to 199. You know what's going to happen? You're not going to get filled. Say the high day was 195. Guess what? You didn't get filled. And now, say tomorrow, maybe it was a pump enough. And guess what? It's back at 35 cents or 95 cents. 95 cents, you still make a profit. But it wasn't the whole dollar plus that you could have made. All right. Rule number 1. Don't buy guess what? Crap. Don't buy crap. Don't buy crap options. Don't buy crap stocks. It's funny because almost everyone who starts trading wants to buy penny stocks. Now, in some cases, people make it really well. Tim Sykes, perfect example. He pumps them up, gets it going on, and pumping up the stock, gets a lot of money going, sends his watch list out, whatever. Say he makes a bunch of money. Cool. He gets 1,000 other people to do it. All these other 1,000 people are buying what he's selling or talking about. So what's going to happen is, Tim Sykes, that wasn't nothing against you. Anyway, don't buy crap. Don't buy crap stocks. Don't buy crap options, okay? But if you're selling options, guess what you're doing? You're putting the odds in your favor, okay? So put odds, let me write this out for you people, in your favor. How do you do this? How do you put the odds in your favor? Selling for premium on a seemingly guaranteed position. You got to make sure that you have a stock that is worthwhile, Now, I'm not just saying selling covered calls, even though I love doing that. It was great. I wrote in my first book about selling puts, and I also put it in the second book. Covered Call Magic, the book I just did. All these books are on Amazon, super cheap. Covered Call Magic was great because it talks about selling the covered calls. In that book, I talk about Intelsat, that filed bankruptcy out of nowhere, killed my whole position. Position dropped to dirt, like literally dropped to 13 cents, and turned around and came all the way back up to I think 89 or something like that. I lost like $7,000 between both accounts on that one stock doing that. But then as it came back up, I actually made all the money back on the premium that I sold the contracts for. Granted, exercise date was 2021 or 2, I can't remember, I think it was 2022. But needless to say, I made all that money back. I bought the contracts still at a super cheap premium. Ended up walking away. It wasn't nowhere near the profit I would have made, but it was still around like $750 or $800, something like that. So put odds in your favor. Stocks. I'm selling puts against Delta because I believe Delta is going to continue up or stay sideways and go up. I do not believe it's going to continue, flopping down because it's hanging around the $25 to $30 range really well. I'm trading shorter expiration. Sure, I could collect a bigger premium if I did a 3 or 4 or 5 week expiration or a 6 month or a year, but I want it constant and I want it now, right? So if I do a 1 week and then I have 2 expiring on the week after that and then another one after that, and I keep it rolling, guess what I'm doing? I'm pulling $100 to $200 every single week, and it's just multiplying money. And that is exactly how this is going to create a beautiful wealth stream of income for what they call passive income, which is money that you're not actually working for actively, plus working in retirement, blah blah blah. Put the odds in your favor. Now, aside from selling for premium, which puts premium in your favor, debit spreads. I don't trade credit spreads. I don't like credit spreads because in the stock market, hype is king of the stock market jungle, right? You cannot predict what is going to happen to a stock. You can guess, and implied volatility could be in your favor, but you're almost better off selling calls against these things than a credit spread. Though the credit spread has a limited strike of loss, so the difference between the strikes is actually your max loss, I almost would rather buy the stock at a higher price essentially by itself versus the credit spread because I'm getting very small credit in return for a seemingly guaranteed thing versus selling the naked call, buying it. Theoretically, they call it unlimited loss because the stock can continue to infinity, which, let's be real, that's not going to happen. Amazon, like Berkshire Hathaway is like $300,000 or whatever, but Amazon is not, not right now anyway. But keep it real, right? Selling puts, to me, it's a great way to make money and trade options, right? So instead of just trying to, basically in this market, I call it educated guessing because no matter how good your technicals are, I've been spot on the money with my numbers, and all of a sudden, just boom, a tweet comes out. Trump comes out tweeting. Somebody else says something, the trade war, all this garbage going on, the coronavirus, all this crap. My positions were worth $80,000 on November 18th had I not sold them, right? So all the SPY puts and Amazon puts I had, all just loaded. If you go back to my Instagram page, you can see all the ones I had. It was like 30-something SPY puts for December this year, 2018. I'm sorry, 18th, 2020. And just massive money would have been made, right? But I sold early. I got caught up with the bull market going in January. I flipped some stuff for Shopify and just was moving too much around and got caught in the mix. And sure enough, February hit, boom. March hit, boom. Just IV is crazy. You can't even get back in the same trade for less than $5,000. Anyway, so what are we going to talk about next? Well, that about covers this. Bid, ask, limit order, market orders. Don't trade crap options. Don't trade crap stocks. Buy something that's valuable, that has moat, which is your reputation of the stock. Don't trade only on indicators. You need to use other indicators to match what you're doing. Don't trade short expirations. Don't gamble on the stock market. Some of you get lucky. Some of you are getting lucky. Even some people I know and some certain chat groups making some buku money on gambling, basically. Whether or not the play is solid or not, putting your entire account on it. I mean, whatever. If you're making money, you're making money. I'm not mad at you. But if you continue to do that, chances are you're going to lose. You'll be really upset with yourself if you walked away with $150,000, $200,000 and you gambled it away back to 10 or 5 or 30. And I actually heard somebody say it was all profit, so it didn't matter. So you tell me that you turn 5 or 10 grand into $150,000, you lost it all back to where you were, but it's cool because it was profit. What? You could have paid your house off, you could have bought a car, you could have bought a new house. I mean, don't forget taxes. But just don't do that. Be smarter, especially if you're young, man. If you're in your 20s and you're making that kind of money and you're over here blowing it on just gambling, you might make it to $1 million. Hey, and I'm glad. I'm very glad for you. But that's not how we trade, man. That's not how you make a consistent living on trading, right? You're not going to be able to pay off debt that way if you're just gambling everything that you make right back into the market. Because guess what? The market doesn't care, has no feelings, doesn't care if your baby mama's pregnant or your wife just lost her job or you can't pay your house payment because you put all your money in the market, you made a ton of money, and then you just lost it all. Guess what's going to happen? It's going to get rough, man. Don't gamble, okay? Don't gamble. That's another rule. Don't gamble. Don't gamble. So, if you like to gamble, whatever, I guess if you want to, if you have good odds, in your favor for the stock or whatever, you really feel, I guess it is better than going to a crap table because you at least have a slightly more benefit on the stock market side versus the casino. So, not condoning gambling in the casino. Anyway, so bid ask on the options and stocks. You really just need to learn to trade. Learn what trading is. What is the stock market? Why is there a stock market? You're buying shares of companies and stuff like that. All an option contract is a right or an obligation to buy or sell a stock at a certain time, which is the expiration date, at a certain price, which is your strike, and that's it. That's all it is. Don't get caught up in what a company's doing 30 years from now, because that doesn't matter. You don't know. We don't know that Tesla will be here 30 years from now. I mean, it likely will, in my opinion, but that doesn't mean it will. That doesn't mean Apple's going to go to 490 or 420 because some analyst said, I think they're amazing. They have all this new crap. iPhones are amazing. MacBooks are amazing. Apple's going to be $490 a share next year. Did I set up a strangled debit spread? Of course I did. I have it going put side, short-term July, and I have long-term side. I think it's September or August. I think it's September for like 470 to 490 or something like that. The spread cost me $60. The payout on the spread is $2,000. For some reason, it gets anywhere near 460. Guess what? My spread will be worth $60 all the way up to probably $900 to $1,500. Okay, that is why I choose debit spreads the way I trade them, and I have some other videos about that you can watch. There's something else I wanted to say, but I can't remember what it was. Indicator-wise, it's always the same. If you look at my screen here, this is actually something I researched, right? So the 13 EMA crossing the 30 SMA, simple moving average, standard moving average, and I also have the 200 EMA. Okay, so the 30 simple is the orange line here, just casually rolling around, and you're actually looking at building support on the 13, pushing here off the 200. So this marker right here, you can pretty much guarantee that Apple was pushing up bullish from the coronavirus effect. But that's going to cut it for tonight. So hopefully this helps somebody. Bid-ask spread. Remember, don't buy crappy options. Don't buy crappy stocks. Trade things that have volume. Trade things that have open interest. Because if you don't, you're going to lose money. You're going to get mad. You're going to cry about it. You're going to complain about Robinhood or Webull or whatever brokers. I've heard people complain about TD Ameritrade now, even though they're still charging you 65 cents, saying that they're crap now because they don't charge fees. But it's the same difference. Get in the trade. If you know the trade is going to be good, get in the trade. Don't complain about $5 or $10 or $1 or whatever the bid-ask spread is. Put a limit order on it. If you don't want to pay more than that, you don't pay. You just don't. You don't get in the trade. So, with that note, have a good one, guys.